Now, the impact of growing global tensions now reaching U.S. airlines. American Airlines and United both suspending some international routes as a precaution, they say. Now, Fort Worth-based American has put flights between Doha, Qatar, and Philadelphia on hold until Sunday.
Global tensions are no longer just a matter for diplomats and defense strategists. They're now reaching cruising altitude. American Airlines and United have both suspended select international routes, citing precautionary measures. One example, American Airlines has paused its Philadelphia to Doha route until further notice. But this isn't just a temporary shuffle. A more profound retreat is underway. Not one marked by turbulence, but by silence. Foreign airlines, including long-standing international carriers with deep U.S. ties, are steadily withdrawing from the American market. Not with headlines or dramatic announcements, but through quiet, calculated moves, trimming routes, abandoning terminals, and vanishing from airport departure boards. And the most startling part? No one in Washington seems to be asking why. Take Iceland's Play Airlines. Come October, they'll cease all U.S. operations. Not reduce, not postpone. Completely shut down every transatlantic route to Boston, Baltimore, and Stewart, New York. All gone after years of expansion. Similarly, Air Canada is slashing 5 major U.S. routes this winter and cutting 30 domestic ones, pulling out of key cities like Detroit, Indianapolis, Minneapolis, Nashville, and Tampa. These aren't fringe routes. They're vital connections for border cities, now severed with surgical precision. This isn't a political protest or a reaction to sanctions. These are strategic decisions by boardrooms, not bureaucrats. But that's what makes this all the more alarming. Airlines don't exit markets they believe in. They exit markets that no longer make sense financially. What we're seeing is a quiet but powerful vote of no confidence in the U.S. travel economy. Play may be the most visible example, but Air Canada, WestJet, Porter, and Flair are all scaling back. Across the Atlantic, Lufthansa and Air France are reducing U.S. capacity. Booking data reflects a 2% plus drop on key European to US routes. Canadian travelers in particular are staying away. Cross-border air and car travel fell sharply in May, and this is just what's been made public. These aren't scrappy budget airlines trying to stay afloat. These are legacy, often state-backed giants, the kind that have weathered oil crises, pandemics, and geopolitical flare-ups. And yet, they're now pulling back from the largest travel market in the world. Canadian bookings into the US have collapsed. In some markets, they're down by over 70%. Air Canada alone has slashed over 300,000 seats from its US routes, and the trend continues. Lufthansa recently acknowledged that demand from the US has plateaued, and they're now planning significant cuts to their transatlantic schedule. These aren't short-term adjustments. Airlines are reassigning long-haul aircraft to Asia and intra-European routes where demand is growing and returns are more predictable. This isn't weather. This isn't politics. This is a structural shift. Let's be clear. Airlines follow the money. When bookings collapse and margins shrink, they don't wait for lawmakers to figure it out. They act. And right now, the US is no longer seen as a growth opportunity. It's being treated as a liability. According to OAG data, Canadian Airlines alone have pulled more than 320,000 US-bound seats from their schedules through October. Forward bookings have plunged. The numbers simply don't work anymore. And this isn't just about empty planes. It's about what they leave behind. This retreat ripples through every layer of the economy. In Buffalo, hotel revenue has plummeted. In Seattle and Detroit, retail spending near airports has dropped over 12%. In Tampa, some international gates now sit idle for months. Flights aren't just being reduced, they're disappearing. Entire terminals are going dark. Joint ventures with international carriers are being canceled. Real estate contracts are being abandoned. Take Stewart Airport in New York. It had one last remaining transatlantic link, a Play Airlines flight to Iceland. With that canceled, its customs wing now sits empty, its international terminal silent. And this silence is costing cities millions in tourism taxes, in payrolls, in jobs that rely on the steady churn of global travelers. Fewer international flights mean fewer foreign tourists, which means fewer hotel stays, fewer restaurant reservations, fewer museum visits. It means fewer cab rides, fewer tips, fewer retail sales. Cities that budgeted for tourists are now facing revenue shortfalls. It also weakens local currencies and squeezes airport authorities who've spent billions expanding terminals in anticipation of more flights, not fewer. Interestingly, U.S. carriers like Delta and United are still reporting strong outbound bookings to Europe. Americans are still traveling, but the flow is no longer balanced. International aviation depends on two-way traffic. When one side pulls out, the system begins to wobble. That imbalance is now being felt in real time. So where are those aircraft going? WestJet has reallocated over 100 transatlantic flights to Europe. Air Canada is shifting focus to domestic and EU routes. Lufthansa and Star Alliance partners are redirecting up to 15% of US-bound capacity toward India and Southeast Asia. Middle Eastern carriers like Emirates, Qatar Airways, and Turkish Airlines are swooping in to fill the gap, but not to serve US demand. They're capitalizing on an open lane in the global aviation chessboard. This isn't just a case of airlines trimming fat, it's a full-scale repositioning, and it's happening fast. Chinese airlines too are rebuilding their long-haul networks, but not toward the US. Instead, they're connecting with Southeast Asia, Africa, and BRICS-aligned economies. The US is quietly being removed from the core of the global aviation grid, and rebuilding that status, once lost, can take years, even decades. This shift isn't being driven by trade wars or political mandates. It's being driven by economics, cold, hard math, and that's what makes it so hard to reverse. A government can repeal a tariff, a president can lift a ban, but when a company exits a market, the vacancy they leave behind often stays empty. There's no hearing, no press conference, just absence. And the consequences go far beyond tourism. When international flights disappear, so do business opportunities. Academic exchanges dwindle, diplomatic visibility fades, global capital follows accessibility. And when routes skip over America, investment often does too. We're not just talking about empty terminals. We're talking about fewer foreign eyes on American cities, less global interest, a shrinking gravitational pull. In short, the United States isn't just being bypassed in the skies, it's being bypassed in the global conversation. And if this trend continues, the real cost won't be measured in ticket sales. It will be measured in lost relevance.